They said it once, you believed them, you paid for it. They are saying it again, right now, today. The same word, the same people, the same lie. But this time, something is fundamentally different. There is a chart, one single chart that they do not want you to see. A collapse so deep, so silent, so irreversible that by the time the world finally understands what it means, it will already be too late. Welcome to the unseen economy here. This is the one place on the internet where we do not shout, we do not hype, and we do not guess. We simply follow the data where others are too afraid to look. Before we go any further, if you are watching this right now and you have lived long enough to remember when a dollar actually meant something, when savings actually grew, when a government promise actually held, then this channel was built specifically for you. Do us a small favor. The way your grandfather used to leave a good book on the table for someone else to find. Leave this channel for someone else to find. Hit that subscribe button, not for us, for the next person who deserves to know the truth before it is too late. And one more thing, drop a comment right now and tell us where in the world you're watching this from. Because what we are about to reveal affects every city, every currency, and every savings account on this planet. Now, let us begin. There's a word that changed the financial lives of millions of ordinary people. It was not a complicated word. It was not a technical term that only economists understood. It was a simple, clean, reassuring word. That word was transitory. And the people who used it knew exactly what they were doing when they said it. In 2021, the Federal Reserve stood before the world and delivered a promise. Inflation, they said, was transitory. It would pass. It would correct itself. The system would heal. The Treasury Secretary repeated it. Financial analysts repeated it. Television hosts repeated it. The word spread like a carefully designed signal. A signal designed to do one thing and one thing only. Keep ordinary people calm while the damage was already happening beneath the surface. The families who believed that word kept their savings in cash. They kept their money in bank accounts, earning nearly zero interest. They trusted the system because the system told them to trust it. And while they waited for inflation to become transitory, the purchasing power of everything they had worked for quietly disappeared. The price of groceries rose. The cost of rent rose. The bill for heating their homes rose. What took a family 20 years to save began to lose its value in 20 months. That is not a small mistake. That is a transfer of wealth on a scale that most people still do not fully understand. The people who did not believe the word acted differently. They moved their money. They bought hard assets. They repositioned into commodities, into real estate, into precious metals. They understood something that the average television viewer did not. They understood that when powerful institutions use calm language during a crisis, it is rarely because the crisis is small. It is usually because the crisis is large enough that they need time. Time to reposition. Time to protect their own interests. Time to allow the damage to reach ordinary people before ordinary people realize what is happening. By the time most families understood that inflation was not transitory, it was already embedded in the economy. It was in their grocery bills. It was in their mortgage payments. It was in the collapsing real value of their salaries. The lesson was expensive. It was painful. And it was absolutely clear. But here is the part of the story that matters most in 2026. The lesson was apparently not learned by the institutions that caused the problem, because they are doing it again. Since the Iran war began, energy prices across the entire global market have moved in ways that history suggests are not temporary corrections. Jet fuel is up 66%, diesel is up 50%, heating oil is up 40%, gasoline is up 32%, fertilizer is up 31%, sulfur is up 67%. These numbers are not appearing in isolation. They are moving together across every major energy commodity at the same time. That pattern does not describe a temporary disruption. That pattern describes a structural shift in the global energy economy. And yet, the response from major institutions has been familiar. The language being used today carries the same tone, the same reassurance, and the same quiet urgency to prevent public panic. They are telling the world that the price spikes are temporary. They are saying the supply chains will recover. They are promising that everything will return to normal once the geopolitical situation stabilizes. They are, in the language of 2021, calling it transitory again. The business community is watching this carefully. Serious economists are watching this carefully. The CEO of one of the largest energy companies in America has already gone on record to say that the futures market is not reflecting the reality of where energy prices are actually headed. He did not use polite language. He said the market might be lying. That is a remarkable statement from a person who sits at the center of the global energy system and sees the supply data that the public does not see. What makes 2026 different from 2021 is not just the scale of the price increases. It is the structural damage underneath those numbers. In 2021, the system had capacity to recover. Supply chains, while disrupted, were not permanently broken. In 2026, the situation beneath the surface is fundamentally different. And understanding that difference is not a matter of opinion or political perspective. It is a matter of reading the data that is already available, data that points in one clear and unavoidable direction. The lie has been told twice now. The only question that remains is how many people will believe it the second time. There is a fundamental difference between a storm and a climate change. A storm arrives, causes damage, and eventually passes. The sun returns. The streets dry. Life resumes. A climate change, however, does not pass. It does not correct itself after a few difficult seasons. It rewrites the rules permanently. It forces every farmer, every builder, every government, and every business to operate inside a completely new reality, whether they are ready for it or not. What the world is currently experiencing in energy markets is not a storm. It is a climate change, and the data makes this impossible to honestly deny. To understand why this energy shock is different, it helps to look at what is actually moving and why. Since the Iran war disrupted global supply routes, the energy complex has not experienced a single isolated price spike in one commodity. It has experienced synchronized explosions across every major energy product simultaneously. Sulfur, which is critical to industrial manufacturing and agriculture, is up 67%. Jet fuel, which determines the real cost of global trade and travel, is up 66%. Diesel, which moves the food, the medicine, and the materials that every modern economy depends on, is up 50%. Heating oil is up 40%. West Texas intermediate crude oil is up 37%. European natural gas is up 34%. Gasoline is up 32%. Fertilizer, which determines the price of food for billions of people, is up 31%. The significance of this pattern is not the individual numbers. The significance is the synchronization. When a single commodity rises sharply, economists look for a specific disruption and model a recovery. When every energy commodity rises sharply at the same time, it means the disruption is not isolated to one supply chain or one region. It means the underlying system itself has been damaged. That is an entirely different kind of problem, and it demands an entirely different kind of analysis. This is precisely where the CEO of Diamondback Energy, one of the largest independent oil producers in the United States, made a statement that the financial media largely ignored, but that serious market participants immediately understood. He stated that the numbers appearing on trading screens do not reflect where the energy market is actually headed. He said that his own board of directors sees a bigger problem than what the futures market is currently pricing. He said the back end of the futures curve might be lying to the market. This was not a casual remark from a mid-level executive. This was a direct warning from a person who controls billions of dollars in energy assets and reads supply data that is not available to the general public. What he was describing has a specific name in economic analysis. It is called mispricing. When futures markets are mispriced, they create a dangerous illusion of stability. Investors, businesses, and governments look at the December contract trading at a relatively manageable level and conclude that the crisis will self-correct before year-end. They make budget decisions based on that number. They make investment decisions based on that number. They make policy decisions based on that number. And when the real price floor arrives, and it is significantly higher than what the futures market predicted, the adjustment is not gradual. It is sudden, severe, and enormously costly. The phrase that economist Peter Bookvar used to describe what the Diamondback CEO was communicating deserves serious attention. He said, "A much higher low in price is here to stay for a while." That sentence contains a complete economic story inside it. A higher low does not mean prices are going to the moon overnight. It means the floor of the market has permanently risen. It means the cheapest energy will ever be, again for the foreseeable future, is substantially more expensive than the world was planning for. Every business model, every supply chain calculation, and every national energy budget built on the assumption of returning to pre-war price levels is now operating on a fundamentally false foundation. The global energy infrastructure that was damaged by the Iran war conflict and its cascading consequences cannot be repaired in months. Independent analysts and energy engineers are consistently reporting that the structural repairs required to restore previous supply capacity involve timelines measured in years, not quarters. Governments that rely on stable energy import prices to subsidize domestic consumption are already beginning to face fiscal pressures they did not model in their annual budgets. What is unfolding is not a disruption that the market will absorb and move past. It is a permanent repricing of the most foundational input cost in the entire global economy. And when the cost of power rises permanently, everything built on top of that power rises with it. Everything, without exception. The storm they promised has not passed. It was never a storm. It was always something far more permanent than that. If this analysis is making you see the situation differently, hit that like button right now. It helps this message reach more people who still believe the official story. And stay tuned, because next we move from energy to silver itself, the 15-year collapse in mining investment, the empty pipeline of new supply, and why this energy shock is about to collide with silver in a way that could change everything. Imagine a farmer who stopped planting seeds 15 years ago. Not because the land was bad, not because the weather was unfavorable, but because the price of crops fell so low that planting made no financial sense. For 15 years, that farmer watched the fields sit empty. He laid off his workers. He sold his equipment. He stopped investing in irrigation and fertilizer, in everything that a functioning farm requires. And then one day, the world suddenly needed food desperately. The supermarkets emptied overnight. The governments panicked. The prices exploded. And everyone turned to that farmer and said, "Plant now. We need the harvest immediately." But the farmer could not plant immediately. The equipment was gone. The workers had moved on. The knowledge had scattered. And even if he started that very morning, a harvest would not arrive for years. That is not a story about farming. That is the exact story of silver mining in 2026. And it is the most important economic story that almost nobody is discussing. For 15 consecutive years, the global silver mining industry experienced a collapse in investment that the industry has never fully recovered from. The numbers behind this collapse are not disputed. Capital expenditure in silver exploration and new mine development fell by 83% over this period. An 83% collapse in mining investment means that the pipeline of new silver supply, the projects that would normally be moving from discovery to development to production, was systematically emptied over a decade and a half. The fields were left unplanted, and the world is now about to discover what happens when it desperately needs the harvest. To understand why this matters so deeply, it is important to understand how mining actually works as an industry. A silver mine does not appear because the price rises and investors decide to fund one. The process from initial exploration to actual silver production takes anywhere from 7 to 15 years under normal conditions. It requires geological surveys, environmental assessments, permitting processes, infrastructure construction, equipment procurement, workforce development, and years of operational testing before a single commercial ounce reaches the market. There are no shortcuts in this process. There are no emergency fast lanes. When the investment pipeline collapses for 15 years, the supply consequences do not appear immediately. They appear slowly, quietly, and then all at once, precisely when the market needs new supply the most. This is where the energy shock connects directly to the silver supply crisis in a way that creates a genuinely dangerous feedback loop. Silver mining is an extraordinarily energy-intensive industrial process. The machinery that extracts ore from the earth runs on diesel. The processing facilities that separate silver from raw material run on electricity. The transportation networks that move the product from remote mining locations to global markets run on fuel. When diesel rises 50% and energy costs across the board surge simultaneously, the operating costs of every existing silver mine on the planet rise sharply. Margins that were already thin after years of suppressed prices become thinner. Some mines that were marginal before the energy shock are no longer economically viable. Rather than increasing supply, the energy crisis is actively reducing the supply that already exists. At the same time that supply is being pressured from every direction, industrial demand for silver is accelerating at a pace that the financial media has consistently underreported. Silver is not simply a monetary metal that investors buy when they are nervous about inflation. It is a critical industrial material with properties that no other element on Earth can fully replicate. The solar energy industry requires silver for photovoltaic cells. Every solar panel manufactured anywhere in the world contains silver that cannot be substituted without significant loss of efficiency. The electric vehicle industry requires silver for battery management systems, electrical contacts, and charging infrastructure. The global push to rebuild and expand electrical grids, which every government on Earth has committed to as part of energy transition policy, requires silver in quantities that current production levels cannot satisfy. The disconnect that has developed between the paper price of silver, the price that trades on futures exchanges and in financial instruments, and the physical reality of silver scarcity in the industrial market is a gap that informed institutional investors have been watching with extraordinary attention. Physical silver, the kind that can actually be delivered and used in manufacturing, is becoming increasingly difficult to source at the prices that paper markets suggest it should cost. That gap between paper price and physical reality does not stay open permanently. When it closes violently. The smart money understands this. They are not announcing their positions publicly. They are not appearing on financial television to explain their strategy. They are quietly, methodically, and deliberately accumulating physical silver. While the majority of the market is still debating whether energy prices are transitory, history has a consistent record on what happens to those who see the supply crisis before the crowd does. And history has an equally consistent record on what happens to those who see it too late. The fields have been empty for 15 years. The world is hungry right now, and there is no harvest coming anytime soon. History does not announce itself when it arrives. It does not send a formal letter explaining that a major economic shift is underway and that people have a limited amount of time to respond intelligently before the window closes permanently. History simply moves, The people who are paying attention position themselves correctly and quietly, build wealth that lasts for generations. The people who are not paying attention realize what happened only after the opportunity has already passed them by completely. In 2026, that window is open right now, but the data suggests with uncomfortable clarity that it will not remain open for much longer. To understand where silver is going, it is necessary to understand where silver has already been during moments that share the same economic DNA as the current crisis. In the 1970s, the world experienced an energy shock that bore remarkable structural similarities to what is unfolding today. Oil prices quadrupled in a short period of time. Inflation became embedded in the global economy. Governments used reassuring language to manage public expectations, while the underlying damage continued to compound. During that decade, silver rose from approximately $1.50 per ounce to nearly $50 per ounce at its peak. That is a move of more than 3,000%. The investors who understood the relationship between energy shocks, monetary debasement, and hard asset repricing did not simply protect their wealth during that period. They multiplied it in ways that transformed their financial lives permanently. The current situation contains every element that was present in the 1970s, and it contains several additional factors that make the case for silver significantly stronger than it was during that decade. In the 1970s, there was no global solar industry consuming silver at industrial scale. There was no electric vehicle sector requiring silver in millions of vehicles annually. There was no coordinated global energy transition policy driving government-level demand for silver-intensive infrastructure. The industrial demand side of the silver equation in 2026 is structurally larger, more diversified, and more deeply embedded in government policy commitments than at any previous point in history. And it is colliding directly with a supply side that has been systematically hollowed out for 15 years. The mathematical pathway from current silver prices to $100 per ounce is not built on optimism or speculative enthusiasm. It is built on the intersection of three forces that are all moving in the same direction at the same time. The first force is the permanent energy price reset, which raises the cost of mining silver while simultaneously accelerating the industrial demand for it. The second force is the 83% collapse in mining investment, which guarantees that no meaningful new supply can enter the market within any time frame that is relevant to the current pricing environment. The third force is the accelerating erosion of confidence in paper currency and institutional promises, which is driving both individual and institutional investors toward hard assets with genuine physical scarcity. When three forces of this magnitude converge on a single market simultaneously, the price outcome is not a matter of speculation. It is a matter of timing. The geopolitical dimension of this story adds another layer that serious decision makers cannot afford to ignore. The global movement away from dollar-denominated reserve systems, which has been accelerating since the weaponization of the dollar in 2022, is creating sovereign-level demand for alternative stores of value. Central banks across the developing world have been accumulating gold at record levels for 3 consecutive years. Silver, which historically trades in a mathematically predictable ratio to gold, has not yet reflected this monetary repricing at the institutional level. When it does, and the data suggests that moment is approaching, the adjustment will not be gradual. It will be rapid, significant, and largely complete before the general public understands what is driving it. For the business community watching this analysis, the risk framework is straightforward. The question is not whether silver will reach $100 per ounce. The question is whether the people making financial decisions today will be positioned before that move happens or after it. Physical silver held directly, and not through paper instruments, or ETFs, is the asset that most directly captures the convergence of forces described in this analysis. The timing of accumulation matters enormously. Every month that passes without action is a month in which institutional money is quietly buying what retail investors have not yet recognized as critically important. The second transitory lie is being told right now. The same institutions, the same language, the same calculated reassurance designed to buy time for those who already understand what is happening. The families and entrepreneurs who believe the first lie paid an enormous price. The families and entrepreneurs who recognize the second lie for what it is and act on that recognition with discipline and urgency are looking at one of the most significant wealth-building opportunities that this generation will ever encounter. The window is open. The data is clear. The only remaining variable is the decision that each person watching this analysis chooses to make with the information now in front of them. In 10 years, there will be two groups of people looking back at this moment. One group will describe it as the turning point where everything changed for them. The other group will describe it as the moment they wish they had paid closer attention. The difference between those two groups is not intelligence. It is not luck. It is not access to secret information. It is simply the willingness to take seriously what the data is already showing clearly and without ambiguity right now. The lie has been told twice. The choice belongs entirely to those who are listening. This is the unseen economy. Thank you for watching until the end. If this video gave you something real, hit the like button, leave a comment with your thoughts, and share it with someone who still believes the official story. I will see you in the next one.